Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 139. And in this episode, we are reviewing the performance of the global markets during the 51st week of 2024. And that is from Monday the 16th to Friday the 20th of December. And without further ado, this is your host, Jamuhuri. And together, let's dive right in. We kick it off in the United States, where on Wednesday, the Federal Reserve lowered its policy rate by 25 basis points, which was the third consecutive rate cut and one that came with a cautionary tone about additional cuts going forward. In a move that was widely anticipated by the markets, the Federal Open Market Committee cut its overnight borrowing rate to a target range of between 4.25% to 4.5%. However, there was little attention paid to the current rate cut, and the main question was on what the Federal Reserve would signal about its future policy intentions, given that inflation continues to hold steadily above the target rate of 2% and economic growth remains fairly solid. The Fed Chairman Jerome Powell said inflation has been moving sideways in 2024 and suggested the central bank may cut rates only twice in 2025 as opposed to the 4 rate cuts indicated earlier. The Federal Reserve raised its inflation outlook and signaled fewer rate cuts in 2025, which left investors guessing how this decision could affect other major central banks and global interest rates. Though most global central banks pride themselves on their independence in monetary policy decisions, a stronger US dollar, driven by relatively higher interest rates, could influence the outlook for policy easing around the world. Staying in the United States, data released on Friday by the Commerce Department showed that prices were broadly flat in the month of November, but still continued to hover above the Federal Reserve's inflation target rate of 2%. The Personal Consumption Expenditures Price Index, which is the Fed's preferred measure of inflation, showed an increase of just 0.1% on a monthly basis and indicated an inflation rate of 2.4% on an annual basis, which was lower than the consensus estimate of 2.5%. And excluding food and energy prices, the core inflation reading also increased by 0.1% on a monthly basis, but was much higher at 2.8% on an annual basis. For your information, the Fed generally considers the core inflation reading to be a better gauge for long-term inflation trends as it excludes the volatile food and gas prices. Over to the United Kingdom. On Thursday, the Bank of England decided to leave its benchmark interest rate unchanged, and this came a few days after UK inflation rose to an 8-month high. Analysts had widely expected the Bank of England to hold its policy rate steady, given that policymakers remain concerned about services inflation and wage growth. So far this year, the Bank of England has already lowered its benchmark rate from a high of 5.25% down to 4.75%. The only deviation from market expectations was that 3 members of the Monetary Policy Committee voted to reduce rates, whilst the other 6 voted in favor of holding the rate steady. And staying in the United Kingdom, on Wednesday, the Office for National Statistics released data showing that inflation in the UK rose to 2.6% in the month of November, marking the second consecutive monthly increase in inflation. Whilst this reading came out in line with market expectations, it was still a significant increase from the rate of 2.3% that was recorded in the previous month of October. Meanwhile, core inflation, which excludes volatile food and energy prices, this came in at 3.5%. Headline inflation in the United Kingdom hit a 3.5-year low of 1.7% in September. However, persistent inflation in the dominant services sector, plus the recent move by the Federal Reserve to put its policy rate on hold, has led money markets to price in almost no further rate cuts in the short term. On Wall Street this past week, the Dow Jones Industrial Average bounced back on Friday to close out a tough week that saw the index plunge by over 1,100 points in a single day. The Dow also suffered its longest losing streak, where it closed in the red for 9 consecutive days, which was the longest losing streak since February 1978. However, some cooler than expected inflation data helped to fuel the rebound on Friday, but despite Friday's rebound, all the 3 major averages booked losses for the week. The 30-stock Dow lost nearly 2.3% for the week, notching its 3rd consecutive losing week, and came to a close at 42,840. Meanwhile, the S&P 500 fell by almost 2% during the week to end at 5,930, whilst the Nasdaq Composite was lower by about 1.8% to close the session at 19,572. Elsewhere, a government shutdown was averted after President Biden signed a stopgap funding bill that will facilitate government funding for another 3 months until Donald Trump takes over. In the U.S. government bond market, the yield on the 10-year Treasury bond retreated on Friday as the Fed's preferred measure of inflation showed cooler than expected price pressures. Comments by Chicago Fed President confirmed that despite the central bank's cautious stance, interest rates could still decline further next year, and this also helped to lift up bond prices. Treasury yields surged on Wednesday after Fed policymakers increased their inflation forecast for the coming year and pointed to only 2 potential rate cuts in 2025, down from the initial 4 rate cuts that had been signaled earlier in September. After topping at 4.57% the previous day, the yield on the benchmark 10-year Treasury bond fell by 4.4 basis points to close at 4.52%. Meanwhile, the yield on the policy-sensitive 2-year Treasury note dipped less than 1 basis point to end the session at 4.31%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equivalent to 0.01%. In the commodity markets, the price of crude oil was stable on Friday as markets weighed on Chinese demand and the prospect of further interest rate cuts after data showed that U.S. inflation was cooling down. The Organization of Petroleum Exporting Countries and its allies, better known as OPEC+, recently cut their growth forecast for global oil demand in 2025. Additionally, JP Morgan sees the oil market moving from a balance in 2024 to a surplus of 1.2 million barrels per day in 2025. The US dollar retreated from a 2-year high on Friday after data showed that US inflation was cooling off, and also after the Federal Reserve reduced its outlook for further rate cuts as it pointed to only 2 potential rate cuts in 2025. Both benchmarks were down by about 2.5% for the week, with the global benchmark Brent crude closing at $72.94 a barrel, whilst the US benchmark, that is West Texas Intermediate crude, was priced at $69.46 per barrel. In the precious metals market, the price of bullion extended gains on Friday and was supported by a softer US dollar and lower Treasury yields after data showed that US inflation was slowing down. In addition to the 2 rate cuts positioned by the Federal Reserve in 2025, the markets are now pricing in the prospect of further rate cuts following the release of the latest inflation data that came out cooler than expected. The prospect of lower interest rates tends to support the price of gold as it reduces the opportunity cost of holding this non-yielding asset. The price of spot gold was up by about 1.1% on Friday and came to a close at $2,623 per ounce. In the cryptocurrency market, Friday was a volatile trading session for crypto as the price of Bitcoin initially dropped below $93,000 before recovering later in the session to hover around $97,000. This volatility was mainly driven by a risk-off sentiment as the Fed signaled fewer rate cuts in 2025 and with investors exercising caution towards risk assets such as crypto. During the previous week, the flagship cryptocurrency hit an all-time high above $108,000 but has since sold off aggressively. The price of Bitcoin has more than doubled this year, supported mainly by the election of Donald Trump, who has promised to implement pro-crypto policies and establish a national strategic Bitcoin reserve. According to Coinmetrics, Bitcoin is up about 145% so far this year and was last seen trading at around $96,597 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling traded sideways versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.29 compared to 129.31 that was recorded the previous week. Meanwhile, the sterling pound was priced at 162.68 and the euro was valued at 134.15. And on the regional front, one Kenya shilling was changing hands for 28.15 Ugandan shillings and 18.41 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.63. The dollar-shilling exchange rate appears to be reverting back to its previous static rate of 129.20, where it was for about 2 months. This price action, where the dollar-shilling rate is trading within a very narrow range for a prolonged period of time, is both unrealistic and unsustainable. The central bank has previously stated that it does not have a target range for the dollar-shilling exchange rate and only intervenes when there is extreme volatility in the forex market. Based on this premise, the central bank should therefore stay out of the domestic foreign exchange market and let the shilling find its optimum rate through demand and supply. That said, the long-term outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves declined by $19 million for a total of $9.01 billion, which is equivalent to 4.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite these, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that has pushed the country to the precipice of a sovereign debt default. On diaspora remittances, the inflow of remittances in the month of November totaled to $423 million compared to $355 million in November 2023, which was an increase of about 19%. The cumulative inflows for the 12 months to November 2024 increased by more than 16% to $4.872 billion compared to $4.175 billion for a similar period in 2023. The inflow of remittances continues to support the country's current account as well as the domestic foreign exchange market. The United States remains the largest source of remittances into Kenya, accounting for about 53% of the total remittances received in November. In the interbank market, during the past week, the liquidity situation in the interbank market was adequate and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this declined by 33 basis points to 11.23%, down from 11.56% the previous week. And in terms of volume, the average value that was traded in the interbank market decreased to 35.5 billion shillings, down from 55.4 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 39.3 billion shillings. For your information, the cash reserve is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 19th of December, and the central bank received bids totaling to 13 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 54%. And the results of the auction were as follows. The 91-day rate declined by 7.6 basis points to average out at 9.95%, whilst the 182-day rate fell by just 2 basis points to stabilize at 10.02%. Meanwhile, the 364-day rate decreased by 22 basis points to settle at 11.53%. In the primary bond market, the Central Bank of Kenya, acting in its capacity as fiscal agent for the Republic of Kenya, has published its prospectus for the January 2025 bond issue and is looking to raise a total of 30 billion shillings for the stated purpose of budgetary support. In this regard, the central bank is inviting bids for the sale of 2 reopened fixed coupon treasury bonds whose terms and conditions are as follows. The first bond is FXD1/2018/15 with 8.3 years left to maturity and a coupon rate at 12.65%. The second bond is FXD1/2022/25 with 22.8 years left to maturity and a coupon rate at 14.18%. Both these bonds are now open for sale until Wednesday, the 15th of January 2025, and the value date for these reopened bonds is Monday, the 20th of January. Please note that the interest earned on these bonds is subject to withholding tax at a rate of 10%. In the Eurobond market, during the week, the yields on Kenya's Eurobonds were on an upward trajectory, with the yield on the 7-year 2024 Eurobond increasing the most by about 50 basis points as it rose from 9.4% recorded the previous week to 9.90%. At the Nairobi Securities Exchange, during the week, the equities market was on an upward trajectory, with the NASI gaining the most by 2.2%, whilst the NSE 20 and the NSE 25 gained by 1.5%, whilst the NSE 10 rose by 1.3%. This takes the year-to-date performance to gains of 39.2% for the NSE 10, 37.9% for the NSE 25, 32.3% for the NASI, and 26.5% for the NSE 20. The market's performance was mainly driven by gains recorded by large-cap stocks such as Bamburi Cement, Absa Bank, and DTB Bank, which increased by 11.5%, 9.4%, and 9.1% respectively. These gains were, however, weighed down by losses recorded by other large-cap stocks such as Equity Group and East African Breweries, which declined by 4.3% and 2.8% respectively. Up next is our topical issue, and this week we're looking at the implications of higher capital requirements for commercial banks. The global rating agency Moody's sees increased competition in the Kenyan banking sector on the back of higher capital requirements for commercial banks that will potentially give customers better pricing in terms of loans and deposits. The Business Laws Amendment Act of 2024, which was signed into law on the 11th of December, requires banks to raise their minimum capital from 1 billion shillings to 10 billion shillings over the next 5 years. The Treasury's proposal to increase the minimum capital was driven by the necessity to enhance the stability of the banking sector, whose assets have grown to 7.7 trillion shillings, up from 2.3 trillion shillings in 2012, when the minimum capital of 1 billion shillings was introduced. Banks will be required to progressively raise their capital, starting with an increase to 3 billion shillings by the end of 2025 and up to 7 billion shillings by 2027, and finally topping up to 10 billion shillings by 2029. The rating agency sees this capital increase as positive for the domestic banking sector because it will improve banks' resilience against potential unexpected financial risk, such as higher credit losses. Additionally, there is also the potential for consolidation through mergers and acquisitions, which will help to create larger banks that will offer enhanced competition to Tier 1 lenders, who currently control about 77% of the net assets in the banking sector, which are valued at about 7.7 trillion shillings. Enhanced competition is also expected to stimulate innovation and improve operational efficiency across the banking sector. The Treasury also noted that the risk profile for the banking sector has changed over the past decade, where now there is a growing prominence for issues such as cybersecurity risk, cross-border risk, as well as climate-related risks. The increase in capital will also bring Kenyan banks more in line with their continental peers. For example, in Nigeria, where banks are required to hold a minimum capital of 200 billion naira, which is equivalent to about $129 million or 16.6 billion shillings. The same case applies in Egypt, where the minimum capital stands at 5 billion Egyptian pounds, which is equivalent to $98 million or 12.6 billion shillings. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. and a Merry Christmas to you all. And remember, if you're not willing to let go of who you think you are, then you will never become the person you aspire to be. Think about it. Thank you, and God bless.